Hi, this is Chuck Oliver. Welcome to the Taxes Saved Case of the Week. We're excited to jump in and talk to you about a client that is a higher income earner and had the goal to get as much of his taxable income down as much as he could. In fact, he almost zeroes it out. And he did that not being a business owner prior, but by being able to create a business that doesn't have a huge amount of human capital outlay, right? We call it being kind of strategically low, human capital outlay. And the other nice thing, and I want people to pay close attention to, is by intentionally creating this loss on paper, you can actually carry it over to take advantage of what we call the loss limitation rule. So we had a client earlier this past week that said, well, look, it sounds like these are for business owners and doesn't sound like it relates to me. Folks, this person was not a business owner. It's creating a business that provides all the extra benefits of tax savings because of the business owner side of things that allows even retirees to benefit from these strategies. So let's jump in, Davis.
Yeah, this is a great one. Probably for those that are listening and have been keeping up with our cases of the week, probably the closest we've gotten to zero tax, right? And
Yeah.
so this is a fun one. And it was also a 2-year plan, right? First year, almost zero tax. Next year, he'll even save more in taxes. So excited to get into this one. As normal, we'll have tax return on the left and what's going on in the scenario on the right, for those that are following here. So I'll share my screen. Hopefully everyone's seeing us here. So here we have for those that are out there that are looking at Roth conversion. I mean, you could look at this two really ways, right? Again, these deductions this client used, you can use against Roth conversion income. You can use this against 1099 income. But for this client scenario, as you're seeing on the screen, it was used for high W-2 income. So what are we seeing here, right? As you can see, really, like I promised, W-2 is what he's got right here on 1Z is him and his wife have high W-2 income. They make a good living, right? A little bit of taxable interest, about $14 there. But right now, with what they've paid in this year from their W-2 salaries and what we help them strategically, next year change on their withholding and using this deduction again, they paid or would have paid in 2024 before deductions and things implemented here about 100 grand in taxes, $99,365 to be exact, that 23.4% effective tax rate. What do we do, right? Here we help them create an equipment leasing business. Here we have two sides of the tax code we can use, whether it's section 179 or 168K, which is bonus depreciation. In this client, for their scenario, it made more sense for them, or what they wanted to do, is get as close as they can to zero with a tax bill this year without zeroing the whole thing out, right? So they decided to use bonus depreciation because for them, they set up a 2-year plan with the amount of equipment they decided to buy and leverage. And so for those that have heard about this program again, right, they're able to put as little as 10% down to start this equipment leasing business. So this client put 85 grand and had a full amount of equipment he can use is he did 359,000 of deduction this year of equipment expense under bonus depreciation and carrying 490,000 of that deduction to this year because his income happened to be higher as he was predicting, and it has been. So he did some forward-looking planning. So all in 2 years, he'll get to use this $850,000 deduction. And this is just the tax savings, folks, we're talking about today. What's nice about this program, not only has it put the ability for him to write off other types of expenses around this business now, because businesses where some of the greatest tax benefits lie, it allows him also to start having generating revenue from his equipment leasing business that he didn't have before without having to quit his W-2 day job. So all in, the first year you guys see here on line 8 of the tax return, he used $359,054 of his equipment deduction. And so before strategies, you see here, right, 424,000, about 425 grand of income, about $100,000 tax burden. After strategies, you see here on line 15, his taxable income after all of his itemized deductions and the equipment deduction brought his tax bill down to $3,579. Not of tax due, but what his actual reported income was, right? His only tax was $358, and so pretty close to zero. A couple $100 is a nice, I think to have to pay over, but all in $1,900 because he had that self-employment tax. Right? So where the government got him a little bit. So right there, you can see this first year ROI was about 100, almost 97,000 and some change of tax savings, 114% ROI on an $85,000 investment. And that was just using 40% of his equipment, right? Year two is where the big ROI hits. In fact, this year he'll use $490,000 of the deduction and save about $120,000 of tax savings just in this year, right? In 2 years of time, he saved $220,000 on an $85,000 investment. And right there, that's a 260% return on tax savings. So this one's fun. As you can see, we can help get as close as we can to zero. Sometimes we run into things like self-employment tax. Every client scenario is different, but as you can see, Dad, this was a fun ROI, especially over that 2 year time frame.
Yeah, there's so much that goes into this. And it's just like a client said this past week, I really want to make sure all things work well together. And one of the things that we find that clients feel maybe they have the least amount of control over, or gets kind of the least amount of attention that ironically they have the greatest amount of control over, are taxes, but it's having a plan, not just a portfolio. So go to taxessaved.com. That's TAXES saved, SAVED.com. You'll see a red square with a white button. Click that. The two case studies take about 20 minutes to go through. One client actually Roth converts $1 million, husband and wife, the other reducing taxable income. But the whole webinar only lasts about a half hour and it's on demand. And then what you do is you request a saving tax optimization plan analysis. But what we want you to do is when you set that meeting, if you scroll down more in the middle of the page, we created some great resources for you. The first one is the One Big Beautiful Bill Act, right? The outcome, the opportunities, and the obstacles, kind of a Reader's Digest 8-page report. Make sure you inform yourself. But also, I want you to focus on getting you a copy of the book I did the forward in, The New Holistic Retirement, pages 49 to 86, where it's all talking about taxes and legislative tax risk. Because mind you, the strategies that we're talking about are based on today's tax rates. And a lot of this stuff changed or would have changed had it not been for Donald Trump and moving forward the One Big Beautiful Bill. So while we have that opportunity, take advantage of the window while we have it. Because keep in mind, permanent tax change doesn't mean permanent in Washington. And the main reason for that is because it's only permanent to the administration that's in office. In fact, there's a running joke that in tax policy in Congress should be written in pencil because the future administrations know how to erase.
Yeah.
So before things get erased, be sure, especially if you're going to tackle Roth conversion, you're a high income earner and you're trying to get to retirement. Maybe you're already retired and you're trying to reduce these required distributions. All of this counts as what we deem active income, and you do not have to be a business owner to create active income deductions. So taxessaved.com, taxessaved.com.